Hello, everyone. This is Anthony from Trader's Ultimate Edge. Let's look first at the SPY. This is the daily candle that the SPY just put in. Pretty much a doji look. It speaks to a lot of indecision in the market. Not really going up or down. Often these are found at the bottom of a pullback, but I don't really trust the markets here. We broke back down the 200-day with a lot of enthusiasm. The market now is very news driven. We have a number of news events this week. We have, of course, all the things going on in Ukraine, and the stuff in Ukraine is what really is moving the market at the moment. Tomorrow, we have the Producer Price Index, which talks a lot about inflation. Wednesday, retail sales, the EIA report. Thursday, we should have the FOMC minutes. I believe that's coming out Thursday. We're also going to have housing, jobless, manufacturing reports. And Friday, we will have existing home sale report. So there's a lot coming out this week. The big drivers are going to be Ukraine and the FOMC minutes, followed by the PPI report tomorrow. The PPI report could tell us a little bit more about inflation, and that, of course, will give the markets a little bit of a heads up of what the Fed might do. But I think, above all, it's going to be Ukraine. Now, we can look at this today. This big fall right here was Ukrainian President Zelensky saying that he believes the attack will start on Wednesday. And then this push back up right here, and I kid you not, ladies and gentlemen, this push back up right here was a report coming out that Zelensky was joking. Like, how do you joke about that? Why is that a thing? What is wrong with you? Okay, I'll get off my soapbox. But nonetheless, that's what happened. You can see how news-driven, news-sensitive the market is. All of these moves were generally algorithms. As it came down here, this giant pop right here, I think was probably just a bunch of algos. It was shorts from earlier in the day. A bunch of algos started taking profit. They snowballed into each other and they all took profit right there. I think that's probably what happened. That started to push the rest of the market up. A lot of algo trading in here. When you see these kinds of wicks like this, it just really speaks to that algo trading. Earlier in the day, we had a lot of patterns showing up too. Normally you don't get this many patterns in a day. We had a descending wedge, then we had an ascending wedge, and then I think there was like another ascending wedge or something that it broke down out of. Anyway, when you see multiple patterns in a day like that, there's just a lot of indecision, a lot of algo trading. Because what those algos do is they draw the edges of the pattern on their computer screens, right? And then the algo knows to go long or short, right, when it gets to the edge of that pattern. So the algos actually help turn patterns into a self-fulfilling prophecy. So, when you keep seeing a bunch of patterns in a day and you see a bunch of wicks going up and down, that it's largely full of algo trading, and I think that's what happened today. There's probably 90% of market movement today was algo trading, and just really based off of that news. So you're not going to beat an algo to the punch when it comes to the news. They spend millions and millions and millions of dollars on these things, trying to get the best news sources as fast as they can, and they worry about getting things in milliseconds. None of us are ever going to beat it. So all we can do is sit back and play the longer. You either play a longer game or you take a neutral stance. What we did today, as the markets came down here in the morning, right about here, we went ahead and sold SPX credit. We sold some really nice positions for about 40 cents each. I took a small handful of them, and they closed up here somewhere at this point later in the day. So that's one way you can kind of play days like this, is with using credit positions. Now, selling credit on SPX is usually a terrible risk reward. I think these were 10 wides for $40. So the risk reward was terrible, but as long as you know how to properly manage them, you know when to stop out, you know when to roll, etc., etc., you'll be okay, especially trading SPX. That's a more advanced strategy that I do teach my clients. We do it all the time in our live trading room. So that's kind of how I'm looking at the market right now, and how I'll continue to look forward to tomorrow. I am looking for a lot of sideways action to continue tomorrow if that PPI report probably comes in right about estimate. Now, if we get some sort of extreme in that PPI report, we could definitely see moves in the market on the back of that. So we'll have to just kind of wait and see. I am definitely still in a bearish mood tomorrow. I don't think we go over the 200-day SMA. I would be shocked if we did and we didn't have some sort of news. Okay, but the market will be really news driven. So I'm going to be looking for deep pullbacks to sell credit, on the downside to sell put credit, and then big pops up to the 200-day, I'll probably sell call credit spreads. That's kind of what I'm looking to do with the market, is just theta decay it. These days are really hard to play otherwise, unless you're good at scalping. We actually did fantastically scalping today, but scalping it's difficult to learn. It's difficult to learn. It's difficult to do properly. So if you're not an advanced trader, if you're still learning, selling credit into these days is a great way to go. And that's probably what we're going to be doing tomorrow. And then, of course, we need to be listening for news. I think some movement on the Ukraine situation should either happen tomorrow or Wednesday. That's what everybody's predicting. So watch for that news to happen. Let's look at the rest of the market real quick. As expected, crude oil had a big push up on the back of the potential, Ukraine invasion information, which turned out to be, quote, a joke. The price of crude oil is not going to really go below 90. I don't think. I think it stays above 90. I think 90 or low 90s is fair market value on crude oil. I really do. I do think it's going to hit 100 before this is done. If we get Ukrainian invasion, I could see 105. And I think it will hit 100. It will go a little above it maybe, even without an invasion. And I think it's probably going to pull back and settle around $90 until we see some sort of change in the supply and demand economics of crude oil, which, at least in the United States for the next couple of years, does not appear likely, as our administration has a lot to do with it, restricting supply and whatnot. And I'm not trying to be political with that statement. I'm trying to be factual. The administration is not friendly to crude oil supply, thus prices get pushed higher. And also keep in mind, we are coming into the summer driving season, when typically crude oil prices will push up a bit anyway. So we can definitely see these prices coming up over $100 here in the next few months, maybe even sitting there for a little while. I think after the summer driving season, we get that pullback back into the 90s, and it'll probably sit down there. Just looking around the rest of the market here, nothing really interesting on the trend. The SPY V, SPY G. Today, growth was really up over value, which I thought was really fascinating. You can see here, this was the open today right here, and value was purchased up heavily over growth for most of the day. This kind of, and this reversal right here was right where we had that reversal in the market. Value started to get bought. And then at the end of the day here, growth started to get bought again. This is a SPY V into SPY G graph. It's really, really useful, especially if you have TradingView. You can pull that up real easy. Put call ratio getting a little high. We got a lot of puts in the market right now. We got 12% more puts than calls. And once this gets nice and high, you can kind of look for a rebound, because basically, and I mean this with the best of intentions, when you have all of the retail traders believing one thing and all wanting to do one thing, generally the market will do the opposite. So we have to keep an eye here on the put call ratio. Jumping over to this next one, you can see the dollar has been pushing up since the 10th back here. The dollar has just been kind of pushing up, and we'll go back even a little bit further. You can see here, generally, it's been pushing up this whole month for the last couple of weeks. Overall, it's been in an upward trend. Keep in mind, the dollar, as it raises in value, will be putting a lot of pressure on the stock markets and make it more difficult for the markets to rise. So the dollar will need to retreat before we would ever see all-time highs again. I believe the dollar needs to retreat quite a bit. We have over here 10-year Treasury notes. Right now they're at 1.997. They did get up over $2 and they sold off pretty quick. So I'm kind of thinking that, 2%. So I'm kind of thinking that 2% area might be equilibrium in the markets. That's where people start to step in and they're like, oh, 2% Treasury notes, might as well buy that. And they start transferring some of their money towards treasuries. Big funds start to pick them up. So that 2% area might be a bit of equilibrium. And keep in mind, if treasuries are going to top out, I'm not saying for sure they're going to, but if they are, then this is probably a near-term top in financials as well. As financials, loan rates are key to the 10-year treasury, and if that pulls back, then financial profits will pull back, especially if they're getting squeezed by a rising Fed fund rate. Also today, important to note, it's not on this chart, but there was 3 and 6 month treasury bill auctions today, and they did not increase in yield, which is a good thing because it means people aren't as concerned about that near-term inflation, and that was actually caused a little bit of a pull up in the markets. That was right about here this morning. That was the bond auctions, and it started to push the markets up a bit. So that's what caused that. And the 6 month yield, I believe, is 0.78 or 0.8. The 10 month is the 10 year is 1.9. Do yourself a favor, go Google search yield curve inversion. When you get a yield curve inversion, it's typically between the 10-year and the 2-year. When the 2-year is a higher yield than the 10, that signals in a recession in the immediate future. We are not there yet, but we are getting dangerously and perilously close. If the Fed does not handle raising rates properly, we can see them push us into a recession. They must raise rates slowly and measured for us to not get pushed into that recession, because that yield curve is getting dangerously close. Check it out. It's really interesting. Google search it, and I'm sure you can find a chart. Last but not least, we'll look at the VIX. The VIX here did not pop out its Bollinger Band. I'm actually going to be posting a video in the next couple of days on how to use the VIX to help your trading. Did not come out of its upper Bollinger Band, so it's still down here. It definitely still has room to move to the upside. I would like to see this thing popping out of the Bollinger Band a bit, coming up here maybe in the mid-30s, something like that, before we really start to see a bottom over this Ukraine thing. Once we see that, I'll probably short it down. That's a strategy that our own Dr. Swing Trade, he calls out trades for us, for our clients in our Discord. That's a strategy that he's come up with, worked entries and exits. And of course, that full video is available for clients in our classroom. All right. That's all I've got for y'all today. Overall, it's a real wait and see environment. It's a real wait and see. It's massively news driven. I am bearish, and I'm going to be bearish until the Ukraine situation is resolved. Hopefully Russia backs off, and or Ukraine backs off wanting to join NATO, which will cause Russia to back off, and we get a little bit more clarity around potential Fed funds rate changes in the FOMC minutes. Until we start to see that sort of thing, I am not going to be bullish. I'm going to be bearish, and we can short down anywhere near the 200-day. I will be looking for a short. All right, thank you for listening. I hope you all have a nice evening. Take care. Bye-bye.